First Intuition. My name is Anne and I'm going to be taking you through our FI mock number 1 as part of these revision sessions. So we're looking here at Finance Act of 2024 and our first session is going to cover task number 1 on adjusting accounting profits and losses for tax purposes. So one of the things that I really like about the AAT assessments is the predictability. So we know that task number 1 is always going to test adjusting accounting profits and losses. So what do we actually mean by that? It's that section of the syllabus where we are given the profit or loss account prepared by a trader and told this includes X, Y and Z. Can you adjust that profit into something acceptable, the HMRC? So can we take an accounting profit and turn it into a tax profit? So in the assessment, this task is worth 8 marks, which gives us about 12 minutes to do it. It will take us a little longer than that because I'm going to be explaining everything as we go along, but that's just something for you to bear in mind if you go ahead and practice some subsequent task 1s after you've listened to this lecture with me. So if you are new to the FI materials, you will see that we start each question with something called a task briefing. I'm not going to review this with you in the lesson, but this is really useful for you to have a look at some point on your own, particularly if you're looking at what this task is about and thinking, well, I have vague recollections of that, but I don't know if I'd remember many details. This is then like a set of revision notes. So you would need for this task to be able to understand how to adjust these accounting profits and turn them into tax profits. And we have to do that for a sole trader, a partnership and for a company. So what we have here are some notes to remind us of the sorts of things that need to be adjusted for. So we've got a list of popular items of expenditure that's not allowed. It tells us to look for the reference material as well, because that's going to be there to help us make sure we're familiar with what's in the reference material. It's provided on exam day. So I'm not going to read through the table because I think it might spoil our question and I want to see what you can remember. But if you would like to, it might be a good opportunity to actually pause the recording and then have a go at the example for yourself and then come back and check whether you agree with what I'm saying about this. In terms of the reference material, section 6 on disallowed expenditure shows us the different types of expenses on the left. It then tells us within that category what is disallowable when finding our trading profit for tax purposes, and then any additional notes to perhaps explain what's going on. So this is available to us through pop-up windows, and I absolutely suggest that you use this. Make sure you know what's here, so you're not learning more than you need to, and particularly where there's fiddly little rules, let's be very careful to use those properly. Okay, so let's go to our question then. Little note here also just before we get to the task to watch out for the different rules that apply if a business uses the cash basis of accounting, and there is a specific rule in the reference material for that, which we'll come to towards the end of the task. So here is the task that they've given us to practice, and we have to calculate, look at the requirement first, calculate the taxable trading profit for Susan's business by entering adjustments to the accounting profit. If there's no adjustment needed, I enter a 0. Don't forget that, because otherwise the examiner might look at it and think you didn't know what to do, so you just left it blank. You're only going to get the mark if you put a 0. If the adjustments are deducted from the accounting profits, then we should show them as negative, which suggests that if the adjustment needs to be added to the accounting profit, then it should be a positive number. So that's what we're going to be doing. We've got a table laid out there with various different potential adjusted costs. and we get from the accounting profit, which is taken straight from the accounts, as we'll see in a moment, and we are going to take it all the way through to something called the adjusted trading profits, which is a profit that's going to be acceptable to HMRC and that is acceptable to be used as a basis for calculating our tax. Right, so now we know what we're doing. Let's go back to the question here. We happen to have Susan's sole trader business, and here is our profit or loss statement. She's opted to use the accruals basis of accounting. So before we go any further, let's just recap on that. The accruals basis of accounting is something that is versus the cash basis is something that's actually new to the syllabus for Finance Act 2024. And the presumption under Finance Act 2024 is that we'll actually be using the cash basis of accounting. That's what tax returns will assume. So they'll just assume that a sole trader will say, here's all the cash that I got in, here's all the cash that I came out, here's the excess, there's the profit, off we go. But based on the AAT practice assessments, the suggestion is that they will still use the accruals basis of accounting throughout the bulk of the numerical questions. Then there'll be the odd question that tests the difference between the accruals basis and the cash basis. And on a year-end tax return, it's possible for our traders to opt out of the cash basis by ticking the box and carry on with an accruals basis, which is what they may have used up to this point. So the accruals basis is going to be very similar to what you have done in Level 3 financial accounting, where we include income in the period it relates to, irrespective of whether it's paid or received, and the same for expenses. So if we have a gas bill, we haven't paid it yet, but we've used up the gas, we put the cost in this period. The cash basis would say, nope, you only put the gas bill into your accounts as an expense when you've paid the cash. So we're assuming here an accruals basis, which is how you would have been producing financial accounts, so what we're more familiar with. Okay, now this statement starts with gross profit. Of course, a profit and loss doesn't usually start with gross profit, so I'll just add in those extra bits. It would usually start with sales, and then we would deduct cost of sales, and that would then give us a gross profit figure. So we're sort of assuming that that's already been done. They're just making the question a little bit quick by saying, nothing to worry about there, you've got a gross profit figure. I've then got wages and salaries. Now, another important point to note as we get to this first line item is that if something is not mentioned in our additional notes, it's because there's nothing to say about it. And if there's nothing to say about it, it's because it's absolutely fine. So I don't need to adjust it. Wages and salaries may have adjustments, but there's nothing here to suggest that they need an adjustment. There's no additional notes. So I'm going to say they are absolutely fine. Don't need to do a thing. The next one is accountancy and legal costs, and that does come with an additional note. So I'm now going to refer to the additional note, and it tells me accountancy and legal costs include. Then it gives me two specific items. They don't make up the total of the accountancy and legal costs. They're just two things included within that total. So everything else is definitely fine. The question is, are these two fine? Is the annual audit fee allowable? Is there any reason that I would disallow the audit fee? Not sure why this person is having an audit, but they're obviously choosing to. Susan is a sole trader, so she doesn't need to have an audit, but clearly is deciding to have one anyway. So an audit fee is always allowed. I don't have any issues with that at all. It's just part of the business. So I'm going to go ahead and say yes, the audit fee is fine, and I don't need to add it back. The next one is a legal cost for a tax appeal. And I always think this one's quite interesting because if you put yourself in HMRC's position here, they have maybe assessed the amount of tax that Susan needs to pay, or she's in some sort of disagreement with them about the tax that needs to be paid. So now she's lawyered up, she's gone and got some legal team her legal costs are £6,650 and she wants to offset that with her expenses to mean that she pays less tax. So the cost of fighting HMRC to say, I don't want to pay tax, she then wants to use as an expense to pay less tax. It's not going to happen. So they're going to disallow any sort of cost associated with appealing against the tax that we need to pay. So that, I'm going to say, is not allowed. It's disallowable, is the other word for it, and it needs to be added back. So we can go to here. The audit fee is fine, no adjustment needed, but the tax appeal is going to be added back. And that's that one dealt with. So that one was a bit of both, but we've done it now. Motor expenses, there's no note. Anything where there is no note, there's nothing to say, so there is no adjustment needed. Can't adjust for things if I don't have any information. Repairs and renewals, I have a note, so let's check. Redecoration costs. Redecoration implies you've decorated before, you're just decorating again. This is just a regular repair and renewal. Nothing special, nothing unique about that. It's not in any way improving the earnings capacity of our building. It's not an extension. If it was an extension and I'd extended my building and as a result of extending the building it now needed to be painted or decorated for the first time, then I'd treat that as capital expenditure. But this is just a regular redecoration cost of something that exists anyway, putting it back into its original condition. So I'm going to say that one's absolutely fine. I'm not going to adjust. The installation cost relating to a new item of machinery. Now the machinery itself would be capitalised, and what that means is I'd include it as an asset. I'd treat it as capital expenditure. And when I treat something as capital expenditure, I include all the costs necessary to bring the asset to its present location and condition. So that can include delivery, it can include non-refundable taxes, it can include testing and installation costs. So the installation costs would be capital expenditure. So they would not be allowable against profit. They needed to be included on the statement of financial position as part of the cost of the asset and potentially get capital allowances. So 6,500 for the new machinery needs to be added back. So the decorating, no adjustment needed, but installation of machine, add it back. That's that one done. Office expenses, no notes, so I've got to assume it's fine. Depreciation, there's no notes, but depreciation is never fine, is it, if we're using an accruals basis. An accruals basis of accounting says depreciation is going to be added back because you're going to replace it with capital allowances. This is our own amount in respect of the wearing out of our assets. And assets do wear out and there is a cost associated with that, but this is our calculation of that using our policies. It's not allowed. We will replace it with capital allowances, which are the tax officer's version of depreciation. So that one is going to be added back and then would be replaced with capital allowances. Maybe not in this question, but oh yes, we have got some capital allowances, just spotted them down on the bottom. Good. Okay, so we'll put capital allowances in instead of depreciation. That's that one. So I've done that one. Other expenses, note 3. Let's go there. Customer entertaining. That one, if you can't remember, is mentioned in the reference material. There's a section on entertaining and gifts. So it starts with gifts, talks about customer gifts there. I don't want a gift at this point, I want entertaining. So let's read on. Customer stroke supplier entertaining is in the column of disallowable. That's easy, isn't it? Customer and supplier entertaining are disallowable because the reference material says so. So customer entertaining, I'm going to say no, not allowed. Food hampers given to staff as gifts. Now you may immediately say, oh, food. I remember there's a rule about food. And it talks here about customer gifts. You're not allowed to make gifts to customers unless they cost less than £50. They can't be food, they can't be drink, they can't be tobacco, they can't be vouchers, etc. But the key there is that rule is for gifts to customers. That's why we have to read the question so carefully. Because look over here in our additional notes, it does say staff gifts and staff entertaining are allowable. We can give our staff food, we can give our staff drinks, we can give our staff cash vouchers, as long as they cost less than £50 per annum and have a degree. We can give our staff gifts and we can entertain our staff. With the customer gifts, the rules apply. So less than £50, not food, not drink, not tobacco, not cash vouchers, and include some advertising. So that is the rule on customer gifts. We're looking at staff gifts. So there we go. No problems with that one. Nothing to disallow. It is for staff. And that little recap there serves as well then to deal with the next part, where we give bottles of wine which have the company logo on to our customers. We don't have any details to know how much the wine actually costs, but that's irrelevant because food, drink, tobacco, vouchers for customers are disallowed, irrespective of whether they've got the logo on, irrespective of whether they cost less than £50. So wine, tobacco, vouchers, food, specifically disallowed, irrespective of the cost. So that one, I'm going to add it all back. So let's do those ones before we move on to the next. Oh, sorry. Lost my page there. Supposed to just be scrolling down, aren't I? Right. So entertaining for customers is not allowed. Food hampers for staff is absolutely fine, so no adjustment needed. And then wine, not allowed. So the next one was a donation to a local charity, £500. There is a section on donations. It says political donations not allowed and donations to national charities not allowed. In the notes it tells us donations to local charities are allowed, but these will only be examined for unincorporated businesses. So you don't have to deal with donations to local charities for a company, just for unincorporated businesses. For companies, you'll deal with qualifying charitable donations instead, so you will have donations in there somewhere, just not in this context. So these are absolutely fine. Small, local, £500, no adjustment needed. Capital allowances are given as an alternate to depreciation, so they will be allowed, but rather than being added back, they will now reduce my profit. So capital allowances are going to reduce the amount of profit, and that should help me to find the amount of adjusted trading profit. So these questions are always going to be relatively similar. My suggestion is to just do as many as you can to see the various different things that may be adjusted for. Check my additions for that one. Oh, that's silly, isn't it? Don't know why I put that in there. I do apologise. I don't think I added it in. It's not supposed to be there. There we go. We said the charity was absolutely fine. It didn't need to be added back. A bit of a brain freeze for me there, I think. Donation to the charity was fine. Okay, so there we have it. Our adjusted trading profits. That's the profit that's now going to be suitable to work out the amount of tax that needs to be paid. So do as many questions as you can on this topic. See as many of these areas tested as you can, and use the reference material. It really is very helpful and means that there is less for you to learn because there is so much here. But you need to be familiar with it. You need to understand it. You need to know what's going to be there and what you still need to learn. Note also where anything has a little asterisk, such as this one. The little asterisk then refers to a point at the bottom talking about the cash basis. And I think the next part of our question deals with the cash basis, so we may well be coming back to that now. So in part B then, choose the correct treatment for the following items in relation to the computation of taxable profit. Assume the business is using the cash basis of accounting. So this business is using the cash basis of accounting, which means that their profit needs to be based on cash in and cash out. So they need to adjust for anything that's not cash in their profit and loss. It shouldn't be there. They're going to be assessed on the cash profit, not the accounting profit, using the accruals basis. So the first thing that we see is included is the profit on the sale of the land. So we have to look at that and say, well, should that be there? Is that cash? And the answer is no, that's not cash. So therefore, I need to remove it because I'm being assessed on the cash basis. I would actually remove it even on the accruals basis because of capital allowances, but on the cash basis, because it's not cash, we're going to remove it. So it's going to be disallowed and it's going to be deducted from the profit. It is a profit itself, so if it has been added into my profit and loss statement, it's made the profit higher. So if I'm now going to take it out and say it shouldn't be there, then the profit will become lower again. So I deduct it. A food hamper given to a customer. Presumably I've paid for that in cash. That would be a genuine cash cost, let's imagine. But that doesn't negate the fact that it's food for a customer. All the rules that we've just seen still apply. So remember what we said about food for customers. Customer gifts are allowed if they cost less than £50, but not if they're food, not if they're drink, not if they're tobacco, and so on. So it's still going to be added back. It's going to be disallowed. It's an expense that we are saying that shouldn't be there. You've made the profit lower because you've paid for these food hampers, but we're not going to allow you to have those, so add them back again. And then the purchase of computer equipment. If we were doing the accruals basis, we'd say, ooh, that should be capital expenditure. So we're going to claim capital allowances instead. This is a big difference, one of the more fundamental differences, I think, as far as the way you might be tested on this, between the accruals and the cash basis. Because if we check the reference material, it tells us here, type of expenses that are disallowable. Then it says capital items. So any capital items that you've spent money on, capital items expensed, it says, are disallowable. So even if it's a capital item that you've included in the profit and loss, it's not allowed because it's capital. You get capital allowances instead. Yep. Now there's an asterisk there. And the asterisk says, capital items, which is what this is, and their associated legal costs are not allowable. Oh, sorry, not disallowed, makes more sense. Capital items and legal expenses are not disallowed under the cash basis, providing the expense does not relate to the acquisition, disposal of a business, of land, of cars, or of an asset that wasn't used in the trade. So it's saying if you use the cash basis, you're not going to do capital allowances anymore. You're just going to claim the cost of the asset, and you're going to say, I bought a computer. That's a cost. I paid cash for it, so it is allowable. So you don't disallow capital expenditure under the cash basis. You just allow it as a cost because you've paid cash for your asset, and therefore you are allowed to claim that as a reduction of your taxable profit. So CapEx is allowable as a cash cost under the cash basis. So once you've actually paid for it, you can include it as a cost, ignore the capital allowances for the cash basis, and just include the cost of your assets. Just deduct them as normal. And that's it. That's the sort of thing to expect from task number 1. It can be testing a sole trader, a partnership, or a company. So please be aware of that. And as I said, get some more exposure to these questions because there are various different things that can be asked in terms of what is added back and what isn't. So if you join me for the next one, we'll have a look at task 2 together.